Have you ever wondered how to manage your money effectively? Well, that's where an understanding of personal finance comes into play. Personal finance is a broad field that covers everything from budgeting, saving and investing, to debt management and retirement planning. It's a topic that's relevant to everyone, no matter how old you are or how much you earn. Why is personal finance so important, you ask? Well, being in control of your finances can lead to a life of financial security. It can help reduce stress, as you're not constantly worrying about money. Plus, it empowers you to set and achieve your financial goals, be it buying a house, starting a business, or even retiring early. In essence, personal finance is about taking control of your financial future. It's about making your money work for you instead of the other way around. Knowing how to manage your money effectively is an essential life skill that can lead to financial freedom. The first step to managing your money effectively is understanding your personal income. Imagine you're setting out on a journey, but you don't know how much fuel you have. It's a bit like that if you're not fully aware of your income. Knowing exactly how much money you have coming in each month is vital. It's the fuel for your financial journey. So, what do we mean by income? Well, it's not just about the wages from your job. Your income can come from a variety of sources. You might have investments that pay dividends, or maybe you have a side hustle that brings in a little extra cash. Some people even have passive income, which could be from rental properties, royalties, or perhaps a business that requires little to no day-to-day involvement. Now, let's talk about net income. This is the amount you're left with after all deductions are made. Deductions can include taxes, social security, retirement contributions, health insurance, and more. Your net income is the money that actually lands in your bank account, the amount you have to play with. It's this figure you need to keep in mind when planning your personal finances. Why is it so important to know your total income? Well, it's simple. If you don't know what's coming in, how can you plan what's going out? Understanding your income allows you to create a viable budget, set realistic savings goals, and make informed decisions about investments and big purchases. So, take the time to sit down and do the math. Add up your wages, any income from investments, and any passive income. Subtract all your deductions. What you're left with is your net income. This is the number that will guide your financial decisions. Remember, your personal income is not static. It can fluctuate with changes in job, lifestyle, or investment returns. So it's important to revisit and update your income calculations regularly. Being aware of your total income is the foundation for any personal financial plan. And with that foundation laid, you're ready to take the next step on your financial journey. Buckle up, because we're just getting started. Once you understand your income, it's time to look at your expenses. Enter the world of budgeting, a journey of self-discovery where you learn how your hard-earned income is spent. Let's think of budgeting not as a restriction, but as a roadmap guiding your financial decisions. It's about spending with purpose and intention, rather than on impulse. Now, the first step in budgeting is tracking your spending. Yes, every penny matters. Tracking your spending may appear tedious, but it's like solving a mystery. Where does your money go? You might be surprised by what you find. The daily coffee, the occasional takeout, the monthly subscriptions you forgot about. It all adds up. After you've tracked your spending, the next step is categorizing your expenses. This is where your detective work pays off. You'll start to see patterns and understand where you can make adjustments. Expenses generally fall into three main categories: fixed, variable, and discretionary. Fixed expenses are the non-negotiables, the costs that remain consistent every month. Think of your rent or mortgage, utility bills or insurance premiums. These are the bills you know you have to pay, no matter what. Variable expenses, on the other hand, fluctuate from month to month. These could include your grocery bills, gas for your car, or your electricity bill. Although they vary, you still have some control over these expenses. Lastly, there are discretionary expenses. These are the fun ones, the lifestyle choices. Eating out, entertainment, hobbies and vacations fall into this category. While these are often the first to be cut in a tight budget, remember that it's important to budget for fun too. Budgeting is not about deprivation, but about making informed decisions about where your money goes. When you understand your spending habits, you can make changes that align with your financial goals. A well-structured budget is a powerful tool for managing your money effectively. Now that you have a budget, let's focus on saving and investing. First up, saving. Saving money is like building a safety net. It's there to catch you when life throws you a curveball, a car repair, a medical bill, or even a job loss. Emergencies can hit anyone, anytime. That's why it's crucial to save for these unexpected events. But saving isn't just for emergencies. It's also about setting and reaching short-term and long-term goals. Want to take a vacation next year? Start saving now. Dreaming of buying a house in 5 years? That's a long-term goal, and saving can help you get there. Now, let's talk about investing. While saving is about setting money aside for future use, investing is about making your money work for you. It's like planting a seed and watching it grow over time. And just like a tree needs time to grow, your investments need time to mature and generate returns. There are several types of investments you can consider. Stocks, for instance, give you a piece of ownership in a company. When the company does well, so do you. But they can be risky as the value can fluctuate based on market conditions. Bonds, on the other hand, are like loans you give to a company or government. In return, they agree to pay you back with interest after a certain period. They're generally considered less risky than stocks, but the returns are usually lower. Then there are mutual funds. These are a collection of stocks, bonds, or other assets managed by a professional. They offer diversification, which means your risk is spread across a variety of investments. Remember, investing isn't about getting rich quick. It's about steady growth over time. And while all investments come with some level of risk, the potential for growth can make them a powerful tool in your financial toolbox. Saving and investing are key components of building wealth and achieving financial security. And with a solid budget in place, you're well on your way to mastering these important financial skills. Debt can be a significant obstacle to achieving financial goals. Debt, in its various forms, is a reality for many. However, it's important to remember that not all debt is created equal. There's a significant difference between what we call good debt and bad debt. Good debt can be seen as an investment. It's the kind of debt that can help generate income or increase value over time. Think of student loans that fund your education, leading to a potentially higher paying job in the future, or a mortgage on a home that can appreciate in value. On the other hand, bad debt typically involves borrowing for things that depreciate in value or don't generate long-term income. Credit card debt from excessive spending or high-interest payday loans can often fall into this category. Therefore, managing and reducing debt is crucial. It's about understanding what kind of debt you have and developing a strategy to tackle it. One basic strategy is to pay more than the minimum due on your debts. This can help reduce the amount of interest you pay over time and can speed up the debt repayment process. It's like taking a shortcut on a long journey. Another effective method is to focus on high-interest debts first. This is known as the avalanche method. Imagine your debts as a mountain. The peak represents your debt with the highest interest rate. By focusing on this debt first, you're effectively removing the peak and making the mountain easier to climb. Also, consider seeking advice from a financial advisor or a credit counseling service. They can help you develop a personalized strategy for managing your debt. Remember, the journey to becoming debt-free is a marathon, not a sprint. It requires patience, discipline, and consistency. But with the right approach, you can successfully manage your debt and move closer to your financial goals. Effective debt management is essential for financial well-being. So let's make it a priority to understand and control our debts rather than letting them control us. So, we've covered quite a bit today about personal finance. We delved into the realm of personal income, understanding that it comprises more than just your salary. It includes other sources like investments and side hustles. We also explored the concept of budgeting. A budget is not merely a restrictive tool, but rather a roadmap to financial freedom, allowing you to see where your money goes and helping you make informed decisions. Then we touched on the importance of saving and investing. Remember, every dollar saved or invested is a step towards financial security. We also discussed managing debt. It's crucial to prioritize paying off debt, especially high-interest ones, to avoid the snowball effect. With these basics, you are now better equipped to take control of your personal finance journey. Remember, financial freedom is a journey, not a destination.